Good morning and happy Friday. Jordan Keck here, your complicated deal guy, coming with another weekly market update. Quick reminder that next Friday is the 3rd, and so that is the observance of Independence Day and is technically a federal holiday, so no closings allowed next Friday, July 3rd. As far as interest rates this week, got a little bit of an improvement down from 6.58% to 6.53% week over week. Starting to see a little bit of an improvement the last couple of days here, especially as things calm down in the Strait of Hormuz. We've seen oil prices come lower, also seen some relief there at the gas pump. As far as our weekly mortgage tip, wanting to talk about the hidden cost of keeping your home as a rental. So this is something I talk with a lot of people about, especially if they have a home, they want to buy a new one, and they're debating, should we keep our current home as a rental or should we sell it? With a lot of conversation on these, I'll tell you that usually I end up suggesting that they sell their home. Now, I think having rentals is a fantastic idea. However, the troublesome part about keeping your home as a rental is that you're missing out on the capital gains tax exemption if you keep it for rental for at least 3 years, which could be costing tens of thousands of dollars in missed tax exemptions. You're not able to put the equity into the new home, so your payments are going to be higher. You're probably not really going to cash flow all that much here. And so in the short term, it is the hardest thing to do. I've never heard anybody say they are so glad they didn't buy real estate 10 years ago, though. But the problem is, in order to get to the benefits at the 10-year mark and beyond, having the price growth, having the additional years of increasing rent so that you're cash flowing well, you got to get through the first 3 to 5 years. So if you or a client are considering it and they have enough cash flow to be able to cover it and don't need to get cash flow from the property, you've got some additional money in savings to cover things as need be, you can afford the higher payments, go for it. Long term, it's definitely the right way to go. You just got to make it through those first few years. Next, we have the Road to Housing Act was passed through the Senate and is headed to the House for a vote. This bill includes several things that are great for housing here and has really been advocated by from NAR and the NAMB for Mortgage Association. And this includes reforming appraisal licensing and training, opening the doors for more trainees, and funding appraisal workforce development. This also aids in the goal of faster and cheaper appraisers with less regulation to be an appraiser, as it's a very high burden right now. We're not seeing a whole lot of new people coming in, and Oregon is one of the slowest and most expensive states in the country for appraisals, even more than California. In addition, the bill includes fixes to manufactured modular housing, home financing, as well as updating FHA loan limits to allow for more homes that borrowers can actually buy. Next, there's continued progress on a U.S.-Iran long-term peace deal. It's now reported that Iran has moved to 30 million barrels of oil now that sanctions have been lifted and the Strait of Hormuz is open. Traffic through the strait has ticked up, although not to normal levels yet. We did see that there was one ship that was attacked. However, it appears that they used a route that was not approved from Iran. Iran said the northern route is open. This ship took the southern route, but so far it seems the northern route is safe and open. Next up, ADP's weekly employment data for the week ending June 6th showed an average of 30,750 jobs created per week. Previous report was also revised higher to 26.5 thousand for the previous 4-week average. And based on this morning's readings, it likely forecast around 130,000 jobs created over the full month period. While this is not extremely strong, it is an indication that the market is starting to rebound and something to watch moving forward. Next, we have PCE, the personal consumption expenditures inflation data for May, up 0.4%, which was in line with estimates. The year-over-year rose from 3.8 to 4.1%, which is just a tenth hotter than estimates, but markets didn't really seem to care too much. The core reading, which strips out food and energy prices, rose 0.3% last month, and from 3.3 to 3.4% year-over-year. Pretty tame overall reading. And lastly, here we got the final reading of Q1 GDP. There's 3 readings. There's the initial, there's an updated, and the final. So this is the final one, and it rose from a 1.6 to a 2.1% annualized growth rate. The gain, however, did not come from consumers, but from less imports, so it wasn't exactly a stronger higher revision there. This means we imported less than previously thought, so there's less of a drag on the GDP growth rate. And within the final reading, though, consumer spending was less than previously thought. While government spending and investment in AI data centers build-outs accounted for the majority of the rise in ADP. As always, hopefully this is helpful. Have a fantastic weekend. I'll see you next time. Take care.